Good morning everybody and welcome back to episode 49 of Quickfire Crypto, where we keep you informed on a bi-daily basis. If you're interested in keeping fully up to date on all things crypto, then subscribe to the channel. We put out a new video every 12 hours. So the story today is an article that I found on CNBC's investigations section of their website, and it's written by Kate Rooney, and it's titled "Celsius clients with collateral stuck on failed crypto platform turn to bankruptcy process for relief." So Celsius was a lending, it was a company actually, but they developed a lending protocol where clients could basically borrow against their own collateral. And it's simplified, that's basically if, for example, you've got one Bitcoin and you don't want to sell the Bitcoin because you think Bitcoin's price in dollars or in pounds or euros is going to go up in value, then what you can do, instead of selling it, you can actually use that one Bitcoin as collateral and take a loan against it. So you give it to, in this instance, Celsius, you give them your one Bitcoin, they will always lend you less. So just for example, they would then probably lend you half a Bitcoin. You then get to go and do whatever you want with that half a Bitcoin. And as long as you pay them back and you make the payments, you'll get your one Bitcoin back as soon as the loan is settled. So you'll have your half a Bitcoin. Hopefully you'll have made some money with that, enough to pay back what you've lent from them. But the catch is, if you do not pay them back or you don't make the payments, you forfeit that collateral. And so you will lose. So you've lent half a Bitcoin from them, but you've left one full Bitcoin with them to basically say that you're good for your word. And that's what collateral is. So if you don't make the payments or you cannot service the debt, they keep you one Bitcoin. And essentially you've swapped them half a Bitcoin and you've given them, they've given you half a Bitcoin, you've given them one Bitcoin because you couldn't make the payments. And that's what Celsius did. Now, it's very useful if you don't want to sell this. There's nothing wrong with collateralized loans. I personally think they're great because they actually, although I haven't taken any out, I just mean the concept of them are great in that it guarantees the lender that they're going to get the money back. Because if you don't pay them back, they're going to get more than they've lent you out, so they're happy. And if you do pay them back, then they're happy as well, and you're happy. So because you've got your loan. So it's really a great sort of way to go about things when it comes to lending and borrowing, in my opinion. So that's what Celsius did. Now, they were poorly managed, nothing to do with this particular way of setting things up, but they were poorly managed, and I believe that all that collateral they were using it to trade. And Alex Mashinsky's got in a little bit of hot water as the CEO of Celsius since then. He's tried to leave the country, and I think there's investigations going on around it and all kinds of stuff to do with the company. So every aspect of what they did was wrong, said Alan Knitovsky, who borrowed $375,000 from Celsius by posting $1.5 million worth of Bitcoin as collateral. So this guy, just for an example, Alan, has put down $1.5 million worth of Bitcoin in collateral, and he's lent only $375,000 against that. So if he doesn't pay that $375,000 back to Celsius, they will keep his $1.5 million. So he's almost certainly he's going to pay that. It almost you would be really stupid not to pay your loan back if so it almost ensures that the loan gets paid back. Because you're going to do anything to pay $375,000 back because you're going to get your $1.5 million back. So it works as collateral works as a really good sort of guarantor for any loan. A former director at Celsius told CNBC that the company's failure to match its assets and liabilities contributed to the hole in its balance sheet. Alan Knitovsky holds an MBA, has worked in technology and finance for over 25 years and is CEO of a mobile software company that trades on the NASDAQ. That didn't prevent him from getting duped by a crypto firm. Knitovsky borrowed $375,000 from crypto lender Celsius. over several years and posted $1.5 million in Bitcoin as collateral. He didn't want to sell his Bitcoin because he liked it as an investment and believed the price would go up. And that's really common with crypto. Well, it's with anything actually, with any financial asset. If you like the asset, you can do it with gold. If you like the asset, then you don't want to sell it. You don't want to liquidate your that particular asset. So you can take a loan against it. That was the Celsius model. Cryptocurrency investors could essentially store their holdings with the firm in exchange for a loan in dollars that they could put to use. Kniatkowski would get the Bitcoin back when he repaid the loan. But that's not what happened, because Celsius, which earlier in the year managed $12 billion in assets, spiraled into bankruptcy. In July, after a plunge in crypto prices caused an industry-wide liquidity crisis, Kniatkowski and thousands of other loan holders had more than $812 million in collateral locked on the platform, and bankruptcy records show Celsius failed to return collateral to borrowers even after they repaid their loans. And I actually know a girl in the UK that lost about £100,000 to this protocol. So it's and she's just she's a chef, actually a self-employed chef. So not somebody rich, not somebody famous, and that was I believe that was all her savings. So she had a lot of faith in this company. Unfortunately, she was at fault for doing that. Every aspect of what they did was wrong. Kniatkowski, who runs an Austin, Texas-based company called Funware, said in an interview, "If my chief financial officer or I actually did anything that looked like this, we would immediately be charged." Creditors are now working through the bankruptcy process to try and reclaim at least a portion of their funds. They were provided with some level of optimism on Friday after Celsius announced the sale of its asset custody platform GK8 to Galaxy Digital. And I think one of the reasons that, this reminds me of FTX and SBF, when with SBF and with Alex Mashinsky in this instance, the CEO or CFO for Celsius, because of the lack of regulation around crypto, there is no real, even though it's quite obviously wrong what they're doing, morally and ethically, and anybody with half a brain can look at this and say it's just wrong, it's stealing. Because there are no real laws in crypto or regulations, there's nothing to actually say that you would go to prison if you did it, if you broke that, because there's no law to break, there's no regulation to break. It's really unusual, and I think the lawmakers are really going to come down hard soon. 2023 I think is going to be the year of regulation, whether we like it or not, because of all this. David Adler, a bankruptcy lawyer at McCarter & English, who is representing Celsius creditors, said money from the transaction has to go to paying legal fees. Beyond that, there could be funds remaining for former customers. The big question is, who is entitled to the money they get from GK8? Adler told CNBC. Adler said he's representing a group of 75 borrowers who have approximately $100 million in digital assets on Celsius platform. So these are in my mind, these are institutional borrowers, because it's a huge amount of money, is that, for just 75 borrowers. So this is not your average person who, your average user of Celsius, retail guy or girl. Because that number would, the individual borrowers would be much higher. Later this month, more relief could be coming as bidding will open for Celsius's lending portfolio. If another company purchases the loans, customers would likely have a chance to repay them and then have their collateral released. So that would be really good. So in this instance, this guy Kniatkowski would be able to pay back his £300,000 loan that he's taken out, and he would get his initial collateral, his $1.5 million back, which I'm sure he'd be very pleased about, because at the moment he doesn't have that option to do that. Kniatkowski told CNBC he had elected to take out his loans at a 25% loan-to-value rate. That means if he took out a $25,000 loan, he would post 4 times that amount in collateral, or $100K. The more collateral a borrower is willing to post, the lower the interest rate on the loan. If the borrower fails to repay the loan, the lender can seize the collateral and sell it to recoup the cost. It's just like a residential mortgage for which the borrower uses the home as collateral. In the crypto world, a borrower can ask for a loan and pledge Bitcoin as collateral. And not just Bitcoin either. You can almost any of the major liquid, highly liquid digital assets. You can use Bitcoin, ETH, Polkadot, all your top ones. Earlier this year, as the price of Bitcoin dropped, Kniatkowski paid off one of his Celsius loans to avoid getting margin called and having to increase his collateral. But after doing so, the company did not return the Bitcoin that was serving as collateral for that loan. Instead, the assets were deposited into an account called Earn. According to the company's terms and conditions, assets in those accounts are the property of Celsius and not customers. So it's really underhand stuff going on here. They're sort of moving money out, swapping it around so that it doesn't, so that it's now theirs and not the customers just because they've moved it. It's there's wrongdoing at play here, in my opinion. Imagine you pay off your car, but someone keeps it, Kniatkowski said. You pay off your house, but somebody keeps it. And that's what's happened here. In this case, it would be like you pay off the loan, and instead you don't get your collateral back, even though it's paid off. Yeah, it's like paying your mortgage off for 25 years, 30 years, making all the payments, doing everything on time, but losing the house at the end of it. It's totally ridiculous and unfair. Failure to disclose. That wasn't the only problem. The crypto platform also failed to provide borrowers with a complete federal Truth in Lending Act disclosure. According to former employees in an email sent to customers on July the 4th, the Act is a consumer protection measure that requires lenders to give borrowers critical information, such as the APR, term of the loan, and total costs to the borrower. The email to borrowers said the disclosures required to be provided to you under the Federal Truth in Lending Act did not include one or more of the following, and then proceeded to list more than a dozen possible missing disclosures. A former Celsius employee who asked to remain anonymous told CNBC that the company was retroactively trying to come into compliance with TILA. You don't get to say, oh, oops, we forgot like 25 items in the Truth in Lending Act, and as a result we're just going to redo them and pray, Kniatkowski said. I hope I'm pronouncing his name wrong. I'm struggling with his name, actually. Jefferson Nunn, an editor and contributor for CryptoNews.com, took out a loan with Celsius and posted more than $8,000 worth of Bitcoin as collateral. He knows those assets are now unavailable to him, even if he repays his loan. So, a strange situation. I mean, if you were in this situation, would you continue paying the loan off, knowing that you may not get the initial collateral back, or would you just forget it and forget the collateral and just keep the loan payments? It's a hard thing to, which one do you do? Nunn, who lives in Dallas, said he got the loan to invest in more Bitcoin after seeing a promotion for the platform. He said he heard about Celsius after doing a podcast with co-founder Nuke Goldstein. On the show, Goldstein said, "Your funds are safe." We've heard this before, haven't we? Nunn said Alex Mashinsky, Celsius's former CEO, made similar comments shortly before halting withdrawals. Guys, when any exchange or lending protocol or any centralized entity or organization starts telling you everything's safe, everything's going to be fine, we're all, a-okay, nothing to worry about. These are classic, signs of them going underwater. It's very difficult to decipher what is nonsense and what is, but basically it's not nonsense, it's pure lies. They're lying, they know that they're going down, they know that they're in trouble, and they're trying to put people's minds at ease and to stop the panic, so that they're trying to limit damage to themselves, not damage to other people. And it's quite sickening. It's basically a mess, and my funds are still locked up there, Nunn said. That theme has come up repeatedly in crypto, most recently with the failure last month of FTX. We know all about them. SBF, the founder and CEO of the exchange, told his followers on Twitter that the company's assets were fine. A day later, he was seeking a rescue package amid a liquidity crunch. Whilst Celsius's implosion doesn't carry the magnitude of FTX, which had been valued recently at $32 billion, company management has faced its share of criticism. According to court filing in October, top executives took out millions of dollars in assets prior to the company halting withdrawals of customer funds. A former employee who asked not to be named said there was a lack of financial oversight that led to significant holes on the company's balance sheet. One of the biggest problems was that Celsius had a synthetic short, which occurs when a company's assets and liabilities do not correspond. The former employee told CNBC that when customers deposited crypto assets with Celsius, it was supposed to ensure those funds were available any time a customer wanted to withdraw them. However, Celsius was taking customer deposits and lending them to risky platforms, so it didn't have the liquidity to return funds on demand. This is almost exactly the same as FTX, and it's based on one thing: greed. Pure greed. There's no other way to say it. They should never have touched anybody else's collateral or anybody else's funds. They make money from, with this type of protocol and this type of business. They can, they're lending you money. They charge you interest for lending you that money. So you give them the collateral, they give you the loan, you make the repayments, and you pay them some interest, and that interest is their margin. That's their profit, if you will. They don't get to, and that's how they should run, how that business should be run. You don't get to just then pick up all the collateral that you've got and then start lending out and doing risky things with it, because this happens otherwise. And not only is it bad for risk, but they are more inclined to take bigger risks, if you think about it, when the money is not theirs, but when it's somebody else's, which you wouldn't you? If there's more chance of, if there's more higher reward, which is usually the case when you take a higher risk, and you're doing it with somebody else's money, then you're going to take more risk, because the chances of, because if you lose, you haven't lost your own money, you've lost somebody else's money, but if you win, you get to keep the money yourself. So it encourages, it's an incentive for bad behaviour. Celsius was taking customer deposits and lending them to risky platforms, so it didn't have the liquidity to return funds on demand. As a result, when customers wanted to withdraw funds, just like FTX is this, Celsius would scramble to purchase assets on the open market, often at a premium, the person said. It was a tremendous error in judgment and operational control that really put a dent in the balance sheet of the organisation, the former employee said. He also said that Celsius was accumulating cryptocurrency tokens that had no value as collateral. On its platform, Celsius touted that customers could earn compounding crypto rewards on Bitcoin, ETH, and 40 plus other cryptocurrencies. But according to the former employee, the teams responsible for deploying those coins had nowhere to go with many of the more obscure tokens. And a good rule in crypto is, just as it is in life, if it's too good to be true, it probably is. If these lending protocols are offering, because it's not just the collateral, that they take from you and then loan you out half of that or 30% of that. You can also lend money to them as well. And so they are saying that they're going to give you, I think one figure I saw for USDC, Circle's USD coin, that they were offering like 19% yield, interest back on users. So if I wanted to lend them $1,000, they would give me, Celsius would give me 19%. Well, that is just so high, and you couldn't run a business on that. They couldn't run a profitable business and give me 19% on my dollars. You just couldn't do it. It don't work. So it's just too good to be true. If it is, then it probably is. The ex-employee said he left Celsius after discovering the company wasn't being prudent with customer funds and that it was making risky bets to continue generating the high yields it promised depositors. A lot of individuals took all of their money out of traditional banking systems and put their full faith in Alex Mashinsky, the person said, and now those individuals are left unable to pay medical bills, pay for weddings, mortgages, retirements, and that continues to weigh very heavily on me and my colleagues that have left the organisation. Celsius didn't respond to multiple requests for comment. Mashinsky, who resigned from Celsius in September, declined to comment. And it's the retail investor, the average person, that gets hit the worst in this, because as I've said before, when they put their money in, when they put US dollars into a thing like this to lend it out, they don't expect somebody to be fraudulently then taking that money and then, trying to get high yields on it somewhere else, or trading it, or lending it to, doing whatever they need to do to get yield back on it. They don't expect that. They just expect that to put their money. They just want the interest, the 19% interest that they thought they were going to get, and they want to and they want to walk away with that. And that's they want a simple relationship with the protocol. They don't want. They just don't expect for things like this to happen. Whereas the institutional investors, whilst they obviously don't expect things like this to happen either, they do. They are aware that it could happen. They do have risk management. Some companies, institutional, have entire teams based just for risk management and for what to work out what the risk tolerance is for that particular company and whether it's worth it. Is it in line with the rewards or potential rewards, shall we say? And so they are aware that they could lose money, but your average person just doesn't usually think like that, and so they end up getting burnt the worst. So that's what I've got for you in this article. Remember, everybody, to please subscribe to the channel, join our team. We'll keep you updated on all things crypto every 12 hours. Smash the like button if you feel you got value from this video, and I'll see you all in 12 hours time.